So welcome to the December 2025, the last roundtable of the year, streamed on YouTube Live. So it's good to see everybody and those that are watching on YouTube. Hello. So today we're going to go over a few things. We're going to do a quick little market recap. We're going to go over the new conforming loan limits. Um, we're going to go out of how to avoid getting all those calls when your credit is pulled. Seems to keep coming back. We're going to go over some new things relating to divorce and when there's joint people on a mortgage and things that they can do short of refinancing. Speaking of refinancing, we're going to take a deep dive into refinancing because I get questions as to, is this a good thing to do? Should I refinance? And what are some of the things we need to consider? And since we're in the holiday season, we're going to talk about gifts. We always kind of like to bring this up in gifts time and gift tax exclusion and stuff. And then one thing I'm going to talk about, and Clay could certainly jump in, is reverse mortgages, what to do when your loan is due. There's always been a lot of confusion as to what people can do if somebody passes with the house or they want to sell the house. Well, selling the house is fine, but or if they're moved into assisted living, what's the process with the reverse mortgage? And then we're going to touch on some private money things. So there's quite a lot of things here that we're going to cover today. So we're going to get started with the market recap. I'm going to share the screen with you. Okay, well, as you can see, according to Freddie Mac, and this came out the day after the Fed funds rate was reduced last week. 6.22 is what Freddie Mac has as the primary mortgage market survey on a 30-year fixed. And if you take a look, here we are, 6.22 as of last Thursday. And about a year ago, we were at 6.6. So there's been a little bit of improvement in mortgage rates over the last year, almost 0.4%. The 15-year was at 5.84, and now it's at 5.54, about 0.3%. So there's a little bit of improvement in interest rates, and we'll see how this progresses through the next year. I know that there's it's always unemployment and inflation and the 10-year bond and all those different things looked at as to determine where rates will go. But it's really the market that determines how rates will work. It's determines on, buyers and sellers of mortgage-backed securities and what are those decisions that they make? What are things that they consider? Yes, they consider unemployment, they consider inflation, they consider bonds in other markets in other countries. So anyway, those are all things that go into mortgage rates. They have come down a little bit this year, so hopefully we'll stay on that trend. I think if we can get in the fives, you may see a lot more activity. Maybe even some refinances. We are going to see some refinances here at 6.22. As you can see, back in January, the rates were over 7. So some people are looking at refinances at these rates. And we'll talk about that here too, about, whether it's a good idea to refinance or not. So that's kind of a brief overview of the market. Any panel, any questions, any comments on the market? Flint, good to see you. I know you were feeling under the weather. It's good to see you back again. Anybody want to chime in on the market? No. The market is what the market is, and then we just kind of work with how it goes. That's pretty much it.
I would like to say, the commercial is also getting lower. Commercial
I'm
rates
sorry,
are
Flint.
commercial rates are also getting lower.
Oh yeah, yeah. We've seen some pretty nice conventional commercial rates, sixes and
Yeah.
sevens. I mean, pretty
Yeah.
good rates. Yeah, so that's also an area where we've seen some improvement. Well, one thing that happens every year is we get the new conforming loan limits, and uh, the baseline new conforming loan limit has jumped up to 832,750 from 806,500. So that's about a 3.26% increase. In high cost areas like Hawaii, the conforming loan limit is $1,249,125. Out by you, Clay, in California, it's still at 832,750, right? You guys are same baseline? Yeah. Yeah. You're on mute, Clay. You're on mute.
Sorry about that, but the expanded goes up to 1,249,000.
Yeah, 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 yeah. And that's exactly where Hawaii is.
Right.
How did they determine that increase?
Well, FHFA comes out with these every year and they have their own analysis, but that's a very good point because I just so happen to have the FHA announcement here. Let me see if I can find it. It's one of the things. All right, let's share the screen.
Well, they have one number, but they'll allow you to extend it to a higher number.
It's 150% on high cost areas.
Oh,
In California. California has high costs. Arizona doesn't. There are certain states that do.
two sets of.
And it's not state, it's actually by region. But
Oh yeah, even more, right. That's right. That's right. Yeah, even or by county or by region, right? Yeah. FHFA announces conforming loan limit values for 2026. Here was the announcement. And they said that the Housing and Economic Recovery Act requires FHFA, which is led by Bill Pulte this year, to adjust the enterprise's baseline CLL value each year to reflect the change in the average U.S. home price. Earlier today, when this was released back in last month, FHFA published its third quarter price index report, which includes statistics for the increase in the average U.S. home value over the last 4 quarters. According to the nominal seasonally adjusted expanded data FHFA, HPI, house prices increased 3.26%, which ended up in a similar increase in the conforming loan amount. So that's how the conforming loan limit has gone up by 832,750, which is an equivalent of the 3.26%.
I find
that's
that
how they
interesting since the housing market seems to be and has been softening.
Yeah, yeah. This is average. This is let's see here. They have their own FHFA price index report. Let's just click on that, see what that
I
looks
wonder if
like.
they're on a delay, like the tax assessor is on a delay.
Well, this goes through the third quarter and September.
Um,
Let's see here. This is their report. Here's something you don't see every day, right? So they have their bar chart, they have their figures, their tables, and they do their analysis. So the FHFA has an analysis that they do. They have significant findings relating to housing. And then through this analysis, here's their quarterly figures. Here's house price appreciation over the previous 4 quarters. Looks like in the 2021 is in the third quarter is where it had its biggest, which we all know because 2021 was a big year. 2025 was only up 2.2% as compared to 2024. House appreciation for the U.S. seasonally adjusted. 4-quarter change is in orange. And you can see here it is above the annualized quarterly change and the quarterly change. And then the 4-quarter house price change by state. In Arizona, it is state by state, John, to your point.
Yeah.
Arizona was down 0.3, but Illinois was up 6.9. And so they do a national, and that's something that we've seen in our loans, is that the loans in in housing in the Midwest, where out here, it was kind of a buyer's market because it has softened. Here in the Midwest, it's always been a seller's market. The deals we did in Illinois this year there were multiple offers, and we had to hurry up and get the loans done and get them through. But that's what they're seeing in the Midwest. So when they make their decision, it's a national decision. There are some states, California down, Arizona down, Texas down, and Florida down. So it looks like the Sun Belt states are down, but a lot of the other ones are up. So that's kind of how they arrive at their figures. Monthly house price index from January 1991 to present. This is interesting, right? One thing that's interesting about how the values of prices have gone up over time is that the tax exclusion for when you sell a house for capital gain tax exclusion has maintained the same for at least the last 20 or 30 years. It's 250,000 for a single family and 500,000 for married filing jointly. They haven't And I would like, if somebody's watching this, please double those exclusions. That'd be great. To 500,000 for single and $1 million for married filing jointly. If they want real estate to move, that's one thing they can do to try to help real estate moving is by including the exclusion, increasing the exclusion on the sale of primary residences.
Marjorie Taylor Greene's proposed that kind of change. And of course, now she's out of favor, so I don't know what's going to happen. Yeah.
Yeah. And
What's that?
she's leaving in January too. So
Yeah.
Can you repeat that whole rule again?
which rule is that, Flint?
Well, I'm getting a little confused with the 120.
Yeah. So
121 rule.
Yeah. So what it is
So
if
when
it's
when
your
you're coming
primary
out of-
residence, if it's your primary residence for 2 out of the last 5 years.
Yeah, that's the 121 rule then.
Yeah, that's it. Yep. You can exclude up to 250,000 in
So
you can exclude up to 250,000 for a single and 500,000 for married filing jointly.
yeah, but essentially you have to use it as an investment property. It can't just be
No,
singles.
primary
No.
primary residence for 2 out of the last 5 years.
Yeah, so 2 out of the previous 5 years. So the other 3 years, you had to
Could
be
be.
renting it out.
Yeah, that's true. Yeah, that's
Could
true.
be.
Yeah, that's true.
Yeah. So that's a good strategy when people are trying to 1031. You get to the end of it, you get to the end of your 1031 cycle 20, 30 years later, and you got several $1 million worth of capital gains. You can go, I took somebody out of a commercial property and we went and bought a bunch of houses. And then they just had to strategically move into them every 2 years. Move into the
Yeah,
houses.
that's a good approach, provided that property values continue to increase.
Yes, well, yeah, but that's it. So they just moved into the house, sell it for 2 years, cash it out, move into the next house, sell it, cash it out, and so then you're done with your capital gains that you did a 1031 deferral for 10, 20, 30 years, whatever.
That's an interesting approach. It's something that I have heard of people actually
It's a-
doing.
Exit strategy.
Yeah. I have heard of people actually doing that as far as living for 2 years and then selling, and then because I see those loans coming through. They live someplace for 2 years and then all of a sudden they're selling and they're moving on. But you just have to remember that as long as the property values continue to go up, right? I mean, you can get hold on here one second.
Well, that's where I'm
Bill's trying to get
conflicted.
into the video, and
Yeah.
I'm trying to email him the link.
So that's why I'm conflicted. I don't think it applies unless you have rented out the property or you're going to rent the property 3 years before or 3 years after your 2 years of occupancy.
Oh, okay. It definitely works for a primary residence as long as you've lived in it a certain amount of time. So it's for the sale of a primary residence. It's not really something. I mean, you could switch properties and all that sort of stuff, but
So what you're telling me is the 121 rule applies to anybody who just buys a house, lives in it for 2 years, sells it, and they get to do the deduction.
Right.
Yeah,
and I'm saying
there may be limits
what-
as far as if you earn so much money, they may have. I don't know if they have limits on that. AGI limits. I can't recall adjusted gross income limits. If
don't
you
think
earn
so.
so much, are there limits on that, Clay?
I don't think so.
No.
Since
Okay.
we're getting the two tax laws, I'm not familiar with the one that allows you to just buy a house, live in it for 2 years, sell it, and you take your cap gains along with you. I'm not familiar with that.
Yeah. I have
Prefer to
a
have-
neighbor.
You can't take the capital gains with you.
You just don't pay capital gains on the gain or taxes on the gain.
Right.
Right.
250 single, 500 couple. But where is what's that law called? What's that tax code law called?
Uh,
Well, I don't know what the tax law was called. I don't
I'll look it
Because
up.
recall. Yeah.
the IRS 121, I mean, sorry, yeah, it's the 121 rule, IRS 121. Where it gives you 2 of the previous 5 as personal residence. And so that's, I'm just wondering, are people actually doing it without doing the 3 years of renting?
Oh, sure.
Oh, it has
The
nothing.
3 years
Yeah,
of renting
again,
is not a requirement.
Oh, it's not.
no.
No,
See, I never knew that.
no, no, no. No, because you can, no, as long as it's your primary residence for 2 out of the last 5 years, you can exclude that much gain. Now, remember, the gain is the sales price less the basis in
But
your home. The
but
basis would be what you purchase plus improvements.
Right,
what,
right.
why is there the 5 years then? Why does it just say 2 of the previous 2 years?
These are the reasons why I chose not to be a tax attorney. Because the rationale sometimes is not there. Flint, you hit a home run with that question. That's exactly why. Because so legislature somehow came up with 5 years, 2 out of the last 5 years, and they passed it. What is the rationale? I'm not sure.
Yeah, I don't know either, but it is section 121 as well, so it's a portion of it.
Yeah, so
And
that's where I'm thinking the
but it
full.
has you can do it every 2 years. I had a
You
neighbor.
can't until you're caught.
What's that?
You can't until you're caught.
No, 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 no.
No, no, no,
It's
no, no,
every
no,
two
no, no,
years.
no, no. It's
They would
legit.
buy. They bought houses in Danville, California, which is was appreciating just fine, and they moved every 2 years, or about every 2 years. They moved, excluded it, moved. Now they're in a $4 million house with no capital gain responsibilities if they sold it. And I sat still, not a $4 million house, but I sat still. I've lived here for 40 years, and capital gains would kill us. So they did it right. They did it intentionally. Guy was an appraiser and he knew exactly what he was doing. So it's my wife and I weren't willing to move. They were willing to move all the time. They were doing better than I am as far as they could sell.
Well, their basis probably increased every time they purchased, right?
Right. But they excluded the gain when they got there.
Right, right.
Now, again, in California has got something that makes it even more interesting is that if you're over 55, Prop 19 allows you to take your property tax basis with you, which
Right.
is not quite the same value, but a pretty darn good.
So that's beautiful. So if you are downsizing and you're an empty nester, well, you wouldn't want to take your tax basis then because you're going to get a
Well,
lower
sometimes you would, because you're selling, you buy your house for, 200,000, you got a tax basis that went up to $1 million. You can go to another $1 million house and take that with you
Oh, okay.
in a location you want. And you could also downsize it and the math might still work. Or if you go to the $1.5 million house, you take $1 million of the new house at the old tax rate and pay the new tax rate at the 500,000.
Yeah, no, that's great. That's great.
Let me make a clarification, or just an addition to the loan limits, is the reverse mortgages go on the higher end of the expanded. So the reverse mortgage principal limit is, or max claim amount is $1,249,125, or will be. So that helps because I'm sure you have properties over $800,000 all over Arizona. So.
Oh yeah, yeah, yeah. No, that's really good. There are, as you know, Clay, there are reverse mortgage lenders who also have their own proprietary reverse mortgage loans that will go over the conforming loan limit as well.
Yeah.
But that's great. No, but that opens it up to more reverse mortgage.
The target market there is somebody that has a paid off home and wants to do their line of credit. Then the standard product works because of the growth in the credit line and the higher values are helping there too. So.
Yeah, no, that's excellent. That's excellent. And we can certainly talk about that a little bit more on another call, because I mean, just growth of the credit line, you and I both know what that means, but somebody that's it may not understand that. We can certainly have another call where we get a little bit more into reverse mortgages. So, Okay, next up, I wanted to talk about www.optoutprescreen.com. And we've talked about this on the calls before, never on our YouTube live, I don't think. But I'm going to go up to that website right now. And this is important only because I keep getting this, I keep hearing from folks that, oh yeah, I have my credit pulled and I'm getting all these phone calls and people are soliciting me and they're trying to call me or whatever. And this is what you need to do to avoid that. You need to go to this website here, www.optoutprescreen.com. And you can opt out of any of those solicitations. And as you see, you scroll down, and it says click here to opt in or opt out. So you click there, and then you scroll down. So you can opt in. So if you want to be solicited, you can certainly choose to do that. You can electronic opt out. If you click this and you click continue, you can electronically opt out for 5 years, automatic opt out, or do a permanent opt out by sending in a letter. That's what I did, and it seems to work because I haven't heard. So, so what I tell my clients is when they come to me and I'm going to do a pre-qualification for them, I say, whoa, whoa, whoa. At first thing you do right now, and I know the next couple of days you're kind of thinking about, being pre-qualified, whatever, being pre-qualified or not. Right now, go to optoutprescreen.com and opt out, because in a week from now, when we finally get around to doing this, because this opt out, they too tell you it can take up to 5 business days to take effect. When we do this, then you will not get calls for solicitations just by having your credit pulled. Now that call to have your credit pulled is called a trigger lead. There was a bill that was passed this year, and I participated in making Congress people aware of it as part of the legislative affairs chair of the Arizona Association of Mortgage Professionals, where they won't be able to do this practice anymore. They, meaning the credit bureaus, will not be able to sell the simple fact of your credit pull to various vendors and what have you, in order for them to, try to sell you, whether it's different lenders or insurance or whatever it is they're trying to sell you. That trigger leads bill will take effect sometime in 2026. Last I heard was March. We'll see. But it was signed by President Trump. We're just waiting for it to actually take effect. If you have an existing relationship with the borrower, you can still contact the borrower. But so if it's a servicer, if it's a bank, whatever, or a broker who we actually did the loan with. But if it's it will eliminate those random solicitations. And I've heard, just recently somebody emailed me and said, my client had 25 different people contact them after we pulled credit, and it's just been so annoying. How can we get around it? And this is it, optoutprescreen.com. So I've already done it. Hopefully everybody here on the panel's done it. It's a very astute thing to do, just so you're applying for a loan, somebody's pulling your credit. That seems to be between you and your loan originator. Not everybody, doesn't need to be broadcast. So next topic I want to talk about was divorce and keeping your mortgage. So we've always known that in a divorce situation, you have both spouses on the loan, and one spouse wants to leave, but the other spouse wants to keep the 3% rate or whatever. And we've said in the past, sorry, you're going to have to refinance to get the other spouse off. So that's the only way you can take them off the note. Well, I had an instance this year where actually they were able to keep the note rate. What they did is they went to the servicer. They called the servicer and they said, hey, we're in the middle of a divorce. I'd like to keep my 3% rate. All they had to do was send the divorce papers off over to the servicer, and the servicer allowed the spouse that remained in the home to assume the mortgage. So that saves with refinance, that saves with a higher rate, that saves on a lot. So it's a great tip out there. So a lot of you that are out there that are in a divorce situation and want to keep that low 3% rate, you can keep it. sorry, Bill's still trying to get in and I'm trying to get him in. Just contact the servicer and send them your divorce paperwork and that should take care of it. Now, let me real quick see if I can get
So
Bill
what do
in.
they issue, a special lien release for the other spouse?
Yeah, well, the other spouse would have to, certainly, the other spouse would have to agree for sure. Yeah.
And qualify, don't they have to?
No, because it's the existing loan. I, I'm not sure that I don't think that you have to, it's not a refinance. So I'm not sure that you have to go ahead and, give them your income documents, your tax return, things of that nature.
It's interesting because releasing, it seems like they'd have to do something because, if the wage earner leaves the home and it's only alimony or something like that,
Good point.
it's different income than they originally agreed to in the loan. I don't know. I haven't
Yeah.
tried it.
No, that's a good point. That's a good point. Yeah, I'm not, I know I had a client actually do this year, and I had another loan originator tell me about this year. So the point of this is just to contact your servicer. Before you contact us and you ask us to refinance you out of it, contact your servicer and see if they'll allow you to keep that low rate. And maybe they will, Clay. Maybe you will have to send in tax returns and what have you. But you may have the opportunity to keep that low rate and after the divorce and still stay in the house. No, not even sell it or what have you. So that just seems like a common sense solution that should have been done some time ago, but apparently that's available now. And as we kind of talked about refinances, let's talk about refinances a little bit more. So we talked about where the rate is today, 6.22%, and how people were up at around 7%. And they're like, well, should I refinance? Shouldn't I refinance? Whatever. What's the reason why people try to refinance? A lot of people will say, well, I just want to reduce my payment. Well, okay. All right. You reduce your payment, but is that enough? Is that enough to refinance? Does that make sense just because you're reducing your payment by $100 a month and maybe you recover your closing costs in 2 or 3 years? And then that's enough? You should also take a look at the interest, I think, on the loan too. So we're going to take a look at the newly published in the Google Play Store just this week, Counsel Mortgage Calculator. May I present to you the Counsel Mortgage Calculator? If you go to the Play Store right now, it's not on Apple quite yet, but it is in Google for those who have Android phones. You get the Counsel Mortgage Calculator, and you can download it on your phone. And this mortgage calculator, now the icon still is the little Android icon. It doesn't have Counsel Mortgage Calculator icon yet. We're still working that out. But you can do it. John tried it before our meeting today, and he was able to get in. So with the mortgage calculator, you can do a loan amount of, let's say, $500,000. Say the interest rate is 7%. And the terms of 30-year fixed. You just hit calculate payment. Boom. Here's your payment. Here's the total interest. Here's the total payment. Then you have an amortization schedule. So you get to see how much in principal and interest you're paying every month. Also, there's an extra payment calculator where if you scroll down, you can say every month I want to pay $200 more. You calculate the impact and voila, you have the time saved. Oops.
You did the opposite on your.
I did. You're right. That's why it was zero. $200 every month, and you calculate the impact. And there it is, 4 years, 10 months. You save $133,000 in interest. So that's a nice little tool. It's a very quick. You can put it on your phone. Somebody's calling you. Hey, I need to find out. Do you know what my payment would be or whatever? Oh, here's the Counsel Mortgage Calculator. By the way, why don't you go ahead and download it on your phone too? So they can download it on their phone too, and it's free. So in this instance, we're going to talk about refinancing and whether refinancing makes sense just by lowering the payment. So in this instance, yeah.
Will that mortgage calculator work for a commercial loan?
Sure.
Shouldn't it?
Sure. Yeah, sure. So, but it's just based on term, right?
Yeah.
So if your term is 25, if its term is 25 years, right? You calculate the payment, it'll give you 33 principal and interest. And then the amortization schedule is here.
If you've got a a balloon on it and you want to put the balloon, is there a place to put that in such that you can get the
as you know, the balloon just is when the note is due, but that isn't the amortization time.
No, I understand. If you want to pay it off, or if you have to pay it off in 10 years on a 25-year am, will that calculate the amount of the balloon due?
Yep, because if you go down here, and 10 years would be 120 months, right?
Yeah. Just go down to the number of months.
120 months, that'd be the balance on the loan.
Okay. All right.
Nice. Very impressive, John.
Thank you, Flint. Thank you. That just took me a little while to put together. I'm taking advantage of AI, guys. There are AI, this one, and when you download it, you'll see it was powered by Famous AI. That's exactly the AI I used. And I said, I'm going to try to create a mortgage calculator, something I've always wanted, branded with Counsel Mortgage. And something that people can download on their phones or whatever. And this is, like I said, we don't have quite yet the icon to say Counsel Mortgage yet. It still has a little green Android guy. And then the next part is to put it on Apple. But this is something, so then everybody, they'll be able to go ahead and calculate their mortgage payments right there on the go, on the phone. So anyway, so let's go to what we were talking about, was whether it's makes sense to refinance. So in this instance, let's say today's rate is 6%, and it's a 30-year fixed loan. Okay. So calculate payment. Your new payment would be $29.97, just short of $3,000 a month. The thing that, and let's say that most loans that have been done are probably, they're not interested because a lot of people had 3% or 2% rates, so they're not interested in refinancing. But in the last couple of years, there's some people that got as high as 8% or 7%. So let's take a look at that. So remember, the monthly payment's $29.97 on this. The total interest is $579,000 over the life of the loan. But let's say you were at 8%. Okay.
Whoosh.
That payment was $36.68, right? So that's $668 more than what 6% is. So $668 is a huge savings. So you'd say, yeah, I should probably refinance. And you probably should, because the total interest is $820,000. When we were at 6%, the total interest was at, calculate payment, $579. So even if you paid 2 years of interest at 8%, which would have been, let me go back to that one. Go back to there. So 2 years of interest, going about $3,000 a month. So 2 years of interest, $3,000 a month, 12, 36, 72,000. You paid 72,000 of interest, but you take 72,000 off of this, and you're at 740, 748, 738. And that's still a lot less interest on the loan at 6%. But where it gets tricky is, let's say that you're in a loan and you've been in the loan and it's been at 8%. Let's go back to that example. And it's 820,000, but you're like in year 10. So let's go back to the year 10. So in year 10, you're still paying about $3,000 a month in interest. Let's see here. No, it goes from 33 to 3,000. Well, let's just say, for argument's sake, that you paid 36,000. So you paid 360,000 in interest already on the loan. Okay. So 360,000, your total interest was 520. So that means you have 460,000 left in interest on this loan. Now you're being presented with a 6% rate on a 30-year term. And although, sure, it's going to knock your payments down by $668, you've just increased the amount of interest on the loan that you're going to be paying by another $100,000. So my point is what is the purpose of the refinance? A lot of people get mortgages for different reasons. Some of them do it for cash flow. Others do it on a macro basis. They don't want to pay interest over the long run. They want us as their advisors to advise them as to what that interest is going to be and how to avoid the payment of interest over time, because the interest you can't get back. So those are just a couple different things to consider. And I've had clients both ways over the years. Some have said, yeah, I want to just lower my payment because I'm in a cash flow. Others are more interested in rate. And what I'll say is typically people of a certain income level and higher tend to be just more interested in rate. They're more interested in the cost of borrowing funds and how that compares to their portfolio. And people that are in their first time home buying and don't have a lot of reserves, they're definitely interested in cash flow because they want to make sure they're just coming out of rent and they want to make sure that whatever they're paying isn't going to hurt their cash flow because they want to be sure they can still continue with their lifestyle. So that's kind of what I wanted to jump into on refinancing, just to make you aware that just reducing your payment may not be enough justification to refinance. You may want to take a look at how much additional interest you may have to pay over time. Anybody want to panel? Anybody want to comment on that? This is an experience.
I'll comment on one I just did for a client. He's getting peppered to death. It's an FHA loan. But even an FHA stream, well, the only thing that makes sense is an FHA streamline. He has plenty of equity now to convert it to a conventional loan. So it's the same sort of thing you're talking about. Well, okay, a new conventional loan at this rate and get rid of the mortgage insurance. Comparing that, it's a little more complex than what you're doing on this one, but comparing it to an FHA streamline that carries over and I showed him, you do the streamline. I know everybody wants to get rid of the mortgage insurance, but this is what it's going to look like in 3 or 4 years. You're going to be better off keeping the FHA loan, oddly enough. I mean, it doesn't, logic says no, but when you do the numbers, it says yes. So it is, we compete with people that are willing to sell something and not, figure out what would be the best option. Because, you hope it's.
Great point, Clay. I completely agree. We compete with people who just say, "Oh, I'm gonna lower your rate," but I mean, lower your payment.
Yeah.
But okay, anybody can do that. We can all do that. But we're going to tell you the numbers. Now, if you still want to lower your payment after that, that's fine. Because like I said before, people have different reasons as to why they want mortgage. Some people are like, cash flow is fine. I will sell a house in 5 years, whatever. I'm fine with cash flow. I just need the cash flow. Other people are like, no, I'm going to look at it macroeconomically. I'm going to take a look at what my interest is and what have you. But that was great. That's a great example. Okay, refinancing. Next, gifts. It's the holiday season and we're going to gift, right? People like to gift. A lot of first-time home buyers right now that I work with get gifts from their folks for down payment. And the gift tax, there's gift tax, and the tax is paid on the donor. And I remember when I first was studying tax many, many years ago, I'm like, why is the donor paying the tax? Because they're not the ones that's receiving the gift. It's the donee. Well, the donor is the one with the money. So they're the one that's paying the tax. The donee doesn't have any money. You're not going to tax somebody who doesn't have any. The donor has the tax. So they get gift starting in 2026 up to $19,000 per donee, from donor per donee. So if there's a married couple, each can give $19,000 to the one child. So that's a total of $38,000. So some people will say, hey, so the most I can gift is $38,000. I want to gift my kids $50,000 for the down payment. And I don't want to pay tax on it. Is there a way to do that? Mm-hmm. Yes, there is. So next year, the annual estate exclusion for your estate tax goes up to $15 million. What does that mean? That means when you pass, the first $15 million of your estate is excluded from taxation. You can take advances off that exclusion. there's an IRS form that you would fill out to take advances against that exclusion. So in the example I said, it was a $50,000 gift. 38,000 is all that's allowed by the gift tax. They would have to take that 11,000, file the form, and eat into that 15 million exclusion by $11,000. Now that exclusion can change every year because it's by Congress, right? So right now it's been increasing. Future years it could decrease, but that's how people avoid gift tax if they gift more than what the limit is on the gift tax. Panel, anybody would like to talk about that issue?
Yeah, the only thing I'll add is if it's a couple, each person can donate 38,000 to each person. You can get the number up a little bit. But
Yeah. So if they're donating to a couple, that's right. It's 19 per each person, and then that's right. That's
I
exactly.
don't understand why they would be taxed because you got your money anyway. You already paid tax to have the money. Why do you get taxed to give your money to your kid?
See, Flint,
Flint
your
should be in
questions are right
Congress.
on today. I mean, you are excellent. These tax questions are perfect because, once again, it's what the legislature passed. There may not necessarily, something I learned years ago, this is my own opinion,
Double
not necessarily the
taxation.
opinion of Counsel Mortgage Group, but one thing I learned years ago is, why do certain tax laws get passed? It's because there are a lot of interests involved, and certain interests want, have influence when legislation gets passed. And sometimes it doesn't make rational. There's no rationale. Sometimes it's just that's what the rule is, and that's what they agreed to, and that's what all the legislators agreed to, and what have you. So why did they years ago say that the donor is the one who has to pay the tax? My guess is because they're the ones who have the money. The donee doesn't have any money, so why would you tax them? So, but once again, excellent questions.
How they determine the rate? The tax. What is the tax rate for a gifted down payment?
Well, there is no tax rate because it's excluded from gift. It's excluded from tax. You can gift, so the children don't have to pay tax on the donated funds.
Right.
It's a gift.
But the donor has to pay the tax.
No, I'm telling you, they can avoid tax up to 19,000 per donee, and even over 19,000 by taking an advance off their estate tax exclusion up to $15 million. So there really isn't an instance where a donor would be paying gift tax if they want to use their estate exclusion. Now, if they have $20 million and they don't want to take an advance off their estate exclusion, then they could probably pay gift tax. And that, what the tax rate is, I'm not sure. I'd have to check the forms.
I see.
Yeah. But so anyway, but 'tis the season, it's gifts. And that's where we're at. So those of you who are thinking about gifting your children, you know how they put bows on cars or whatever, and the car company said, we're going to sell more cars by putting bows on these cars or whatever. You put a bow on a house, gift down payment to your kids. You can put a bow on the top of the house. You can put it right there on the door or whatever, and we can help you with the loan. So there you go. Okay. Next thing I wanted to touch on is an area where there's always been a lot of confusion. It's in reverse mortgages, and it's what to do when your loan is due. And I've got something I want to pull up here for you. And this is a nice little from reversemortgage.org. Let me see if I can find this here. Where is it? Oh, come on. I had it up here a minute ago. Just bear with me, guys. Sorry about this delay. This is live television, so that's what happens in live television. Let's see here.
As long as you don't go back to black and white.
The TV is going to go off at midnight, and then you're going to hear the national anthem. There's a lot of people who may be watching this that have no idea what I just said or what I'm talking about. Right. So let's see here. Oh, here it is. Okay, it was here. Can you guys see that?
Not yet.
Okay.
No.
No, that's all right. Let me see if I can pull it up. Okay. How about now?
Got it.
Yes.
Okay. So this is on reverse mortgages, and I've had this question asked of me quite a bit recently. What to do if your loan becomes due? So this is an easy guide for reverse mortgage borrowers and their families. Your HECM, which is a home equity conversion mortgage, that's what a reverse mortgage is called, would be paid back in full when you reach what is called a maturity event. Okay. Um, and the maturity event is step by step. What is a maturity event? When you pass your way, sell your home, convey title to someone else, live outside of the property for more than 12 consecutive months due to physical or mental illness, you have reached a maturity event, and the reverse mortgage must now be paid back. So, Clay, one question I had in the last week was, if somebody goes to an assisted living, how much time do they have before they have to do something with that house in a reverse mortgage? It seems like to here, according to this, they have up to 12 months.
Yeah, I think a more correct way to describe it is what the outlook is. If the outlook is they're never returning for sure and all that, they should work on repaying the loan. If there's serious stuff, but breaking, I don't know, whatever, but their intent is to come back, you can go on indefinitely.
Yeah. Oh, that's interesting. Well, that's true. That's true.
Yeah.
That's true. The second step is, and this is, by the way, from reversemortgage.org. Okay. And we'll put the link in our show notes.
This is the National Association publishes this.
Yes. Yeah. The National Reverse Mortgage Lenders Association. That's correct. So step 2 is contact your servicer. When a maturity event occurs, you or your heir should immediately contact the loan servicer by telephone. Within 30 days of being notified, the loan servicer will mail a due and payable letter to the borrower or borrower's estate that discloses the current loan balance, explains the options for paying back the reverse mortgage, number of days to respond, and options to avoid foreclosure, et cetera, et cetera. Anything you'd like to comment on that step there, Clay?
I'm in the middle of it. My stepmom passed away and we had a reverse mortgage for her.
Sorry to hear about that.
And you just had a very testy couple of conversations with this servicer. I said, listen, I know the rules. I know what I'm doing. And you're making it very difficult to communicate. They were really pushy about getting the home listed and all this, just got to do this. And I said, I know what we have to do. We have a home that you can't just list tomorrow. It's full of antiques. It needs some work and all that. So, you just have to document who you talk to. And I found a little frustrating, and I feel bad for clients. And I have a better perspective is the person on the other end of the line is going to a file and following their script as opposed to somebody that really is thinking about it and realizes, okay, and finally, you just have to be firm about it, what your plans are. You communicate them, don't be wishy-washy. And I told him, listen, I will let you know within 45 days, or I will have it listed within 45 days. And that date is, I don't know, was a couple of weeks ago. And I really don't expect to communicate with you between now and then. And they didn't, and they got their listing of, so you have time, but you also have to communicate. That's probably the best description.
Yeah. Step 3,
They
plan to
have
pay off
six-
your debt. Go ahead.
They have 6 months. Is it 6 months to sell it or refinance it?
You have 90 days, and then you can get pretty easy to get an extension for an additional 90 days. And then you have to document what you're doing to get one more extension. And the last one, they're getting kind of grumpy, and you can get up to a year. It's not correct to describe it as you have a year to sell a house. And I explain to clients the reason for that is the holder of the servicing or the mortgage holder loses the benefit of FHA's guarantee of the loan if they don't get it resolved within a year. So they lose it. It's just done. And that means they're on the hook for whatever happens. And I mean, if there's plenty of equity in the house, that's maybe a different story, but they don't want to get into that point, and that's why they're pushy about it. And understandably so. The client signed up for it in the beginning, but again, communication is the key.
Yeah, and right there, Flint, you led right into this step 3. Payment is due immediately, but the estate may have up to 6 months to satisfy the debt. And then, as Clay said, you may be able to continue to negotiate another 90 days, and then maybe another 90 days after that for a maximum of a year.
So you don't want to keep it and make it an Airbnb?
Cannot. That's
Well,
against the. It has to be primary. Well, go ahead, Clay.
yeah.
Well, no, I
You
thought the
can't
kids.
keep
I thought
the
the kid.
reverse
I thought the
mortgage.
kid. I thought the kids can pay it off.
Yeah, they
Oh, yeah, the
can.
kids can pay it off. Sure.
Yeah, they can
Kids can pay it off.
refinance it, pay it off,
Yeah.
use it for whatever you want,
Yeah.
but you can't keep the Heckham loan that
No.
reverse mortgages do.
Yeah, that's why I said sell it or refinance it. That doesn't mean anything about keeping a reverse. It's sell it or refinance it is
Yep.
2 exit strategies I understood. So it could become an income stream as an
Yeah,
Airbnb.
well, sure it could. Of course, then you'd have to negotiate with your siblings as far as maybe put an agreement together. Who's going to be maintaining the property? Who's going to be collecting the rent? Who's going to be so? But you probably would want to figure that out with your siblings if you have siblings.
Yeah.
Step 4, go ahead. Anybody? All right. Step 4 is settling the loan. If the initial due and pay letter, also called a demand letter, is not responded to, or if the 90-day extensions have expired and the property still is not sold, the borrower has no heirs to help pay off the loan, or the loan is not otherwise satisfied, then the servicer may be required to initiate foreclosure. And step 5, if the loan cannot be settled, you face foreclosure. So anyway, this is a cool little, I've had people ask this of these issues of me in the past. I found this to be a helpful little easy guide for reverse mortgages and their families. Clay, what do you think of this little guide here?
Oh, I give it to everybody you talk to in
Okay,
advance.
so yeah, so you're familiar with it, yeah, and we'll have a link to it in our show notes. So it's definitely something that somebody asks you about reverse mortgages. What happens when the loan is due? Here it is. You can just hand this out. So.
The CFPB has a couple of extra booklets and stuff that are also useful, as much as government can be useful explaining this stuff.
hurry up and get them while CFPB is still around.
Yeah, I've got a stack.
So Clay, do you like using? Do you use Finance of America with these reverses?
Out of the 5 lenders I have, they're my least favorite.
Oh wow.
And it's a relationship you have with the account executive. I don't know. I work really hard to figure out how to make something happen for a client, and so I ask a lot of questions, and I like to understand. I don't accept the answer. We can't do that. Well, okay, no. Why? So you can figure out if they misunderstood, or I could change the circumstances to fit their program. And I got in a tiff with one of their AEs about it, and I ended up getting the loan done just fine. But I did that just so anyhow. They're a little bureaucratic to work with and whatever else. There's 5 or 6 really good lenders out there, and we have great relationships with. We generally stick to 2, Longbridge and TMAC. Longbridge and TMAC. If you ever want a conversation, get in more detail, just call me. But Finance of America has a second.
We're signed up with all these lenders, Clint, just so you know.
Oh, under our category of reverse. Okay.
Yeah.
One thing that Finance America has, nobody else has, is a no payment second loan.
Yeah.
Which is pretty cool.
Home safe second.
Yeah, that one's pretty cool. Yeah. And then some of the others have stuff that Finance America doesn't have, so it's good to kind of check it out. And
Yeah, I did some of the Finance of America class training and stuff, and then I just didn't have time to create marketing traction in that. So not to say I wouldn't in the future, but trying to
It's
figure out.
something you can put on the calendar for next year. The NRMLA, the National Reverse Mortgage Lenders Association, has a continuing ed course that is, I don't know if it's most of it, but it is focused on reverse mortgages. So instead of all
Yeah,
the fluff you get with the the class, the 8 hours, I don't know, 4 or 5, 6 hours of it is devoted to reverse mortgages, and a great way to learn. And some of the part is pretty technical, and you get really deep involved in good understanding of it. It's worthwhile. I've taken it for the
yeah,
last 3 years, and I've learned something every year.
yeah. That's great. Mostly it's the marketing of it. That was the piece I didn't have time to develop.
Yeah, well,
So
they cover a bit of that too.
Well, as the baby boomers is still the biggest generation, and they have entered those ages, you may start seeing more and more of these products.
yeah, it just
40,
seems like a huge market available. Yeah,
46% of the home buyers the last 2 years have been 60 plus.
Wow.
There you go.
Wow. Yeah. And now you can do, there's some lenders will go down to 55 on these.
Yeah, the proprietary stuff will go down. Yeah,
yeah,
but the numbers are big enough, 60 plus, that's where I focus on. At least it's hard to market to everybody 55 and older and say, yeah, but it because the numbers at 55 are a little rough.
Sure.
I think.
Big down payment.
Yep.
Okay, so that's a little bit on reverse mortgages. And the last thing that I had on the agenda was hard money fix and flips. I found a couple lenders who have told me we could do 90% loan to value on a fix and flip. I'm like, what? Or 85% loan to value. So I have a couple lenders out there, hard money lenders, that if anybody has not a lot of funds and you want to test these guys, I'm willing to test them with you, and and see if what they're advertising is really true. And the rates are pretty good too, a little under 10 on a hard money loan. They call themselves quasi hard money, but fix and flips 10 to 15% down. I couldn't believe it. So I found those. Just wanted to share that with you. And if that's something you're interested in, I'll show you those lenders. So
only residential, only SFRs.
yeah. These were SFRs. Yeah, single family residences. But would they do a strip mall or an office condo or whatever? Not sure. You can certainly reach out to them and find out. After all, it is quasi hard money, which is business purpose, commercial. So those are the things I had on the agenda for our holiday, December 2025. Anybody going anyplace fun for the holidays?
I came your way for Thanksgiving, which is our holiday because of the switch back and forth for kids. We went to Flagstaff, had a great time.
Oh, that's great. That's great. That's great. Everybody just staying local in their area. Bill, what's the
I'm
temperature?
already here, John.
Oh, there you go. All right, so
Yeah.
here we go. So Bill's in Hawaii,
Here
and
in
Mike's
Indiana.
in Indiana. So Bill, what's the temperature in Hawaii right now?
Can you hear me? Is my mic on?
Yeah. So what's the temperature in Hawaii right now?
I think it's 83 right now.
Mike, what's the temperature in Indiana right now?
What's 38 and sunny?
Oh, okay. Well, so it's not freezing.
Yeah,
So
today's our warm day. Tomorrow it's going to be the high. I think it's 20.
Oof.
Yikes.
Yeah.
With wind chills down to, I don't know, something less.
When it was, I'm from Chicago, as you guys know, so it just makes you feel alive when you step outside, doesn't it, Mike?
Yeah,
you wake up like, woo, let's go.
They call it invigorating.
Invigorating. That's exactly right. It's invigorating, that cold.
No polar
Anyways,
plunge yet.
hey everyone, have a very safe, happy holiday. This will be on our YouTube channel. It usually takes a day or two for YouTube to put it up, and then we'll just go through, and then we'll just follow up next month. But these have been great, and I really appreciate everyone's participation. There's a lot of knowledge that we put out here on these calls, and hopefully somebody will pick up something and they'll learn something from this, and that'd be great. So anyway, happy holidays, happy New Year, and we'll see you in the new year.
Yeah,
Same
Merry
to all of you.
Christmas.
Thank you.
All right, take care,
Merry
guys.
Christmas.